How to calculate cost basis for capital gains tax. Imagine you bought some stocks or funds a few years ago and now you're thinking about selling. How do you figure out how much profit you made? That's where calculating your cost basis comes in. Knowing your cost basis helps you determine your capital gains or losses, which directly impacts your tax bill. Let's walk through the steps to do this accurately and easily. First, find out what you originally paid for the investment. This includes the purchase price plus any commissions or fees you paid at the time. For example, if you bought shares for $1,000 and paid $10 in brokerage fees, your initial cost basis is $1,010. If you bought multiple lots of the same security at different prices, you'll need to keep track of each purchase separately. Next, add any reinvested dividends or capital gains distributions to your cost basis. If you received dividends and used them to buy more shares, those amounts increase your total investment. For example, if you received $50 in dividends and reinvested that into more shares, add $50 to your original cost basis. This adjustment helps you get a more accurate picture of your total investment. Now, choose a method to calculate your cost basis if you have made multiple purchases of the same security. The most common methods are first in, first out, or FIFO, where you sell the oldest shares first. The average cost method adds up the total cost of all shares and divides by the number of shares to get an average price. Specific share identification allows you to select which shares you are selling, giving you control over your gains or losses. Your choice depends on your investment strategy and tax goals. When you decide to sell, determine the net proceeds by subtracting any selling commissions or fees from the sale price. For example, if you sold shares for $2,000 and paid $20 in fees, your net proceeds are $1,980. Then, subtract your adjusted cost basis from this net amount. If the result is positive, you have a capital gain. If negative, a capital loss. Special situations also affect your basis. If you receive the asset as a gift or inheritance, different rules apply. For gifts, your basis is usually the giver's original purchase price, but it can be adjusted if the asset's value has changed. For inherited assets, the basis is generally the fair market value at the date of death. Bonds may have additional adjustments for accrued interest or market value changes. To keep things simple and accurate, always keep detailed records of your purchases, commissions, reinvestments, and sales. Your brokerage statements often provide this information, but it's wise to maintain your own records as well. Using the correct cost basis calculation helps you report your gains or losses properly on your tax return, which can reduce your capital gains tax liability. Remember, accurate calculations mean you pay only what you owe and avoid potential penalties. By understanding how to calculate your cost basis correctly, you can make smarter investment decisions and stay compliant with tax rules.